What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis on DraftKings stock. This is ticker DKNG. This is another stock I've owned for a couple of years now, and we're going to do some analysis to find out if the stock is currently a good buy or a good sell. So, if we take a look at the stock chart, we're going to see the stock is $20 a share, and the market cap is $8.3 billion. So, it went IPO in 2019, and it went all the way up to $72 a share. Then in the last year, the stock is down. It's up 8% on the year, but it's down significantly from where it was at, let's say, 2 years ago. And now the stock is, in the most recent quarter, it reported earnings, and they were a little bit better than expected. So the stock has been moving up. It's up 41% in the last month. And I remember when I bought my shares at $24 a share. So I sold some of my shares for a loss, and I still have 60 left. But when I bought my shares at $24, I remember being very confident that that was going to be the bottom, because ARK Invest had started buying more and more shares right around that time. And that gave me a little bit more confidence. But now I know that's definitely not something you want to rely on, is just seeing a hedge fund or another company buy shares like that. But DraftKings is one of the biggest apps and providers of sports betting and fantasy sports. And the one thing that I really like about this company is they have a partnership with ESPN, which not a lot of other companies do. And something we're going to get into in the middle of this video is kind of about how, for a lot of companies, their moat or what makes them unique might be that there's going to be a switching cost if you switch to one of their competitors. But in this case, this industry is a little bit different, where many sports betting apps, there's not really a switching cost when you go from one app to the next. There's actually the opposite. You actually get those big bonuses where you're going to get a free $50 bonus, or you can, do up to $1,000 risk-free and things like that. So it's very hard to find one of these type of companies that is going to be able to have loyal users on their platform, because whether we're talking about DraftKings or FanDuel or WynnBET, or there's a ton of other apps that do the exact same thing. There's BetMGM. There's all these different competitors in this space that are offering incentives for people to join their platform. So it could take some time before we see this kind of condense and consolidate into just a couple of major players in this space. That being said, this is still a major space that is growing very fast. And we know that there's still several states that in America that have not legalized this yet. And so that's the big growth catalyst for this industry and all of these companies, is that they're going to be able to capitalize on this. We see that many people that are into sports betting, they are very interested in it. And it's something they do sometimes every day, if not every weekend. And they're willing to throw lots of money at it. So it's definitely a good industry to be in at the moment. And let's get started with this. The top two things on our list are going to be looking at revenue and net income. And if we look at DraftKings revenue, they've done a fantastic job growing revenue. What we'll see is in 2017, they did $191 million. And in the most recent year, they did $2.2 billion. So that is over a 10x in the last 5 years, which is incredible. Over the last 5 years, they've averaged 63% revenue growth. And in the last 2 years, they've averaged 90% revenue growth. So that's almost as best as you're going to get out there in today's market. That definitely gets a check. As for net income, it's a different story. What we're going to see here is 5 years ago, they were losing $75 million. And this past year, they lost $1.3 billion. And a large part of that is due to how I said these type of companies are giving out those incentives and spending all that money on marketing, giving out free bets and all that sort of stuff. So definitely not helping their net income. So that will get a no, but the revenue will get a yes. Then we get to number 3, which is the valuation. I gave this a check because it's currently trading at a price to sales of 2.8, and they're averaging 63% growth. So let's go to, once again, this is a market cap of $8.3 billion, and they're expected to do almost $3 billion this year and $3.5 billion next year, which is 31% growth for this year and 22% growth for next year. So definitely we see revenue growth slowing down a little bit, but 22% and 31% are still fantastic numbers. So let's say we put this at a let's take the middle. Let's take 26%, right? So we go to 26%. We're gonna look at my chart here. 26% revenue growth. We'll put this at about a 10 price to sales. A 10, maybe an 11. So really, let's use a 10. Really, I would value this at about a $30 billion company. I think you could get away with a price to sales of 10. Yeah, let's see. Well, if it slows down to 22%, then we're talking maybe a 9. But either way, we're looking at about a $30 billion company or so. And right now we're at an 8. So I believe there's some room for this stock to move up. So that will get a check. Number 4, is it innovative? Yes, definitely would consider this an innovative company. This whole sports betting thing is, at least digital sports betting on apps, is something that is, just recently became a really popular thing in the last 3 years to maybe 5 years. And we're still in the middle of it. We still haven't seen all the states legalize it. So there's that. And there's also, how I talked about earlier, one of their moats is their partnership with ESPN. Not every other company can say that. But there's no switching costs, really. There's switching incentives. So it makes it even harder on these companies to keep customers. But overall, I'd give it a yes. I think they're doing something that's innovative, and they have somewhat of a moat. Is the industry growing? Yes. Sports betting is expected to grow at 9% a year. Definitely good enough. And then all of these are going to get a no because they're losing money. Not healthy cash flow, no return on invested capital. They don't have diverse revenue streams, and they're not growing equity. So those will all get a no. If we want to look at equity, what we'll find is that not only is it not growing, but let's get a better look at this here. We're going to see 1.6 billion. So it was negative a couple of years ago. So it hasn't been, they made some improvement, but then it's been going in the opposite direction. Now we're down to 1.4 billion of equity. So if we compare that to the market cap, though, it's not awful. I've definitely seen worse, but it could be better. Then we're going to go to, is it over 15% of the market cap? Yes, it is. They have 1.4 billion in equity, and it's an $8.3 billion company. So that will get a check. Then we go to the share count decrease. This is a very important metric we need to look for. And what we're going to find is that it's really been stagnant the last 3 years. So, but there was a huge jump from 2019 to 2020. But overall, it's not really decreasing. So we're not going to give that a yes. Is there a healthy amount of debt? I put yes because, well, we can see they have current assets of 2.1 billion, and that almost takes care of all their liabilities. So I would say I would consider this a healthy amount of debt. We're going to see 1.2 billion of current liabilities, and then 1.4 we got 1.4 like long-term debt, and let's see what else we got here. Yeah, 1.4. So it's not bad. It's definitely in a healthy spot. Respectable management, I put yes. For one, so they're not profitable. Yes, that's not good, but they've done a great job growing revenue. Their debt is not that bad. Their share count is not out of control. It's not like they're diluting shareholders like crazy, like some companies are. So those are the things I'm looking for. And I've seen them a couple of years ago, I made a video on this company, and that's when they were talking about integrating Polygon, the blockchain, into their network. I don't know exactly where they're at in that whole process, but that's something to keep in mind. And then they have that partnership with ESPN, which is a respectable move there. So those are some good things to look out for. Number 14, they do have more cash because they don't have any income. Number 15, there's no dividend. And 16, this company was founded in 2012. So that will get a no. So overall, it's an 8 out of 16. Technically, it's not considered a buy. But if you are going to buy it, just keep in mind that what the risks are here and all the things they need to catch up on. So I guess my closing statements would be, this is a great space. This is a great industry to invest in, sports betting. But it's very early on, and so we need to be careful that we don't pick the wrong player and we don't invest too much money in one of these riskier stocks that we still don't know what it's going to look like 5 years from now. So, but DraftKings has a pretty good chance at being one of the big players. So that's the good thing. So overall, we'll see. Maybe I'll keep some of my shares, but it's something to look out for. I will catch you guys in the next video.